Economic collapses are rarely sudden events. They are the final act in a long drama of structural change, where yesterday's certainties become tomorrow's vulnerabilities. The casino economy. From 2020 through 2024, the global economy operated under conditions that resembled a casino more than a marketplace. Extraordinary monetary accommodation, with interest rates near zero and massive fiscal stimulus, created an environment where risk-taking was systematically rewarded. During this period, more than half of S&P 500 companies delivered annualized returns above 15%, while approximately 90% showed positive annualized returns. The mechanics were straightforward. Abundant liquidity flowed through financial systems, lifting asset prices regardless of underlying fundamentals. This was not merely a stock market phenomenon. Venture capital flooded into speculative technologies, commercial real estate valuations disconnected from occupancy rates, and corporate debt accumulated at historically low interest rates. What mattered most was participation, not discrimination. Investors who simply placed chips on the table found themselves winning more often than not. The system appeared stable because everyone was winning, creating a self-reinforcing cycle of confidence and capital allocation that obscured growing structural imbalances. Strain beneath surface. By 2024, pressures began accumulating beneath the surface. Inflation, initially dismissed as transitory, proved persistent, forcing central banks to abandon their accommodative stance. Interest rates rose from near zero to over 5% within 2 years, dramatically altering the cost of capital. Corporate debt issued during the low-rate period now required refinancing at significantly higher costs. Commercial real estate faced a dual challenge. Rising borrowing costs combined with structural shifts toward remote work left office buildings half-empty and valuations plummeting. Meanwhile, the artificial intelligence sector revealed its own fragility. Most so-called AI startups were merely interfaces wrapped around third-party models, creating dependency chains where wrappers relied on OpenAI, which relied on Microsoft infrastructure, which depended on NVIDIA hardware. Each layer added margin pressure without creating durable competitive advantages. Foreign investors holding over $30 trillion in U.S. assets began adding currency hedges against dollar depreciation, recognizing that 15 years of dollar strength were ending. The casino lights were coming up, revealing the house edge that had always been present. Attempts at adaptation. The response to these pressures followed predictable economic patterns. Corporations shifted focus from growth at any cost to efficiency through technology. Management teams across industries emphasized automation, bureaucracy reduction, and resource reallocation toward highest return projects. Artificial intelligence transitioned from being primarily a revenue story to a cost revolution, with companies deploying technology to reduce labor expenses rather than create new products. Central banks attempted delicate balancing acts, trying to contain inflation without triggering widespread defaults. Fiscal authorities faced their own constraints. Rising debt service costs limited stimulus options, while political pressures made structural reforms difficult. And hitting which means, in the technology sector, the most vulnerable companies, those built entirely on rented intelligence, began failing first. Their business models collapsed under simple arithmetic. They paid model providers per user interaction while charging subscription fees that couldn't cover costs at scale. Survivors were those who owned infrastructure, distribution, or proprietary technology rather than merely wrapping someone else's API. These adaptations were logical responses to changing conditions, but they couldn't address the fundamental issue. Too much capital had been allocated based on yesterday's assumptions about risk and return. Erosion of confidence. By late 2025, confidence in the old model had eroded significantly. Labor markets told the clearest story, while headline employment numbers remained respectable. Underlying measures showed weakening. The 3-month moving average of job growth excluding healthcare turned negative for the first time outside recession in 25 years. Layoff announcements increasingly cited efficiency initiatives, automation, restructuring, cost-cutting rather than cyclical weakness. In financial markets, the shift was equally pronounced. Approximately 40% of S&P 500 companies were heading for negative annual returns, a dramatic change from the previous period where 90% showed gains. Foreign investors accelerated their hedging activities, with European investors alone holding $8 trillion in U.S. assets beginning to protect against dollar depreciation. The AI ecosystem revealed its prisoner's dilemma. Wrappers needed scale but couldn't afford customer acquisition costs. OpenAI needed wrapper distribution but couldn't guarantee their survival. Microsoft controlled infrastructure but depended on NVIDIA's hardware monopoly. Each player acted rationally in their own interest while collectively undermining system stability. Trust in broad-based, momentum-driven investing had broken, replaced by skepticism and selectivity, the necessary transformation. Early 2026 represented not a sudden crash but an inevitable transformation. The mathematics of the previous system no longer worked. Corporate debt refinancing at higher rates consumed cash flow that previously funded growth. Commercial real estate valuations required downward adjustments of 30 to 50% to reflect both higher financing costs and structural demand shifts. The AI wrapper economy collapsed under its own contradictions. Middlemen without proprietary technology, distribution, or infrastructure couldn't survive when capital became discerning rather than abundant. Axie markets completed the adjustment. The US dollar, having appreciated 40% over 15 years, depreciated 11% in the first half of 2025 alone, with forecasts suggesting another 10% decline through 2026. This wasn't merely a currency move, it reflected changing perceptions of U.S. growth differentials, interest rate trajectories, and fiscal sustainability. What emerged was a different kind of market, one where dispersion mattered more than direction, where quality commanded premium valuations while fragility faced severe discounts. The casino had closed, the investment office had opened. Returns would come not from betting on everything, but from careful selection of assets with durable cash flows, strong balance sheets, and competitive advantages that could withstand higher capital costs. Historical patterns repeated. This transition from speculative excess to disciplined investment represents one of history's most consistent economic patterns. South Sea Bubble of 720, the railway mania of the 1840s, the dot-com boom of the late 1990s all followed similar trajectories. Technological or financial innovation creates extraordinary opportunities. Capital floods in indiscriminately, valuations disconnect from fundamentals, and eventually the system corrects toward sustainable models. What distinguishes 2026 is not the pattern but the specific technologies and dependencies involved. The AI revolution, like previous technological transformations, will ultimately create enormous value, but not for all participants equally. The infrastructure providers, the companies with proprietary technology, the businesses that can harness automation to improve productivity, these will capture the benefits. The wrappers, the middlemen, the purely speculative plays, these will disappear. History shows that after every period of broad-based speculation comes a period of discrimination, where capital flows to quality rather than momentum. The year 2026 represents such a transition, from gambling to investing, from speculation to analysis, from hoping for broad participation to demanding specific advantages. This is how economic systems evolve, not through sudden collapses, but through gradual reallocations of capital toward more sustainable models.
Found this interesting? Subscribe to the channel. Give this video a like, share it out, and drop your questions or ideas in the comments. Until our next adventure.